There was a big uproar a couple weeks ago about a new form being used during audits of crypto investors. This form lists over 100 exchanges and DeFi platforms, and you're supposed to indicate if you'd ever used any of those exchanges, DeFi platforms, or wallets. And people say, "Oh, this is intrusive." The IRS can ask these questions, and you would be legally obliged to do it. They could put you in a deposition under oath to answer questions related to this. So you can definitely do this form. Now, is it a perjury trap? Yes. Let me tell you how you get out of it. You do it by stating that to the best of your knowledge, that these answers are correct. That kind of weasel word of best of your knowledge at the time that you did it allows you to have opportunity to remember something you forgot because, oh, yeah, yeah, I remember I had some money on BitConnect years ago, or I had money on some Bitstamp that I can't get out, or Bittrex. So even if it turns out later it's not complete, it doesn't hold you into a perjury trap because you had the signature caveat as under the best of my knowledge. So not to fear. A lot of people are confused about their 1099 DAs that they may have gotten, say, from multiple exchanges, and then trying to report that on your tax return when they're also using some crypto tax software to calculate their capital gains, and the numbers are just hard to match up. The short answer is you need to account on your tax return for all your 1099 DAs. That you did this is recorded in the metadata when your return is electronically filed. So you want the IRS to know that you considered it. But what you want to do is just subtract off. It's what's called an adjustment. Subtract off all the profits that the 1099 DAs are reporting. And that's on your form 8949. And then put the output from your crypto tax software in as the new answer. And this will be more accurate. When you do your taxes, you have to fill out a form 8949, which rolls up to Schedule D. This 8949 is basically like a spreadsheet. It lists all your sales, your buy price, your sell price, the dates that happen. And you can do that in a summary fashion. You don't have to list every single trade, as long as you have the detail if you get audited. The transactions on centralized exchanges, transactions on decentralized exchanges, peer to peer, you throw them all together. That's how it's reported to the IRS. Now, it might be that your software breaks it out somehow, whatever it takes to put it on that form so you're communicating the full picture of the total proceeds and the total cost basis of the things you sold and exchanged throughout the year. That's all that's necessary. The 1099 DA is just a vast cauldron of confusion that the IRS has cooked up to confuse taxpayers and tax preparers alike. All right. Even accountants are firing tax preparers because they don't want to even have to deal with the 1099 DA. And it's just a mess. One of the reasons is of their own making. The instructions in the regulations, Section 6045, for the brokers to report differs from the rules that you as a taxpayer have to use. So the problem is the regulations that you as a taxpayer have to comply with in Section 1012 of the Internal Revenue Code, it specifically states don't use the dates that were provided by the brokerage. Use the dates from your own assets when you're doing this sort of thing. Tax preparers are really concerned about the 1099 DA. And the reason is they don't understand how to input the data into the tax return. Here's why. For stocks, they have a form called a 1099B. And it's broken down by the short term trades, the long term trades, and those trades that they know what the cost basis was and not. But they have summary totals on the total amount. And when you get your 1099B from your stockbroker, it's going to have at the very top the totals and what amounts to put in each box, if you will, of the tax return. The 1099 DA doesn't do that. It gives you all this excess level of detail, but it doesn't summarize in a way that a tax preparer is expecting the information that they need to enter into the tax return. They're forcing the tax preparer to whip out a calculator and start to add up different numbers and try to figure out how they calculated it, because I would say it was not intuitive. And tax preparers are like, I don't have time for this. I'm only charging a few $100s in this tax return. Goodbye. We're not doing it. You're on your own. And and that is completely the wrong reaction that the IRS has achieved. Their whole idea was to improve compliance. Instead, they're actually aggravating the non-compliance. Let me explain it. The brokers have to map the sale of an asset with when you bought it. Now, if you bought, say, Ethereum 2 years ago and you moved it to a private wallet, then on Coinbase, you bought more Ethereum 6 months ago, but then from your private wallet, you move that old Ethereum onto Coinbase. Now, Coinbase doesn't know the cost basis of the old Ethereum. It just knows that some new stuff arrived. Here's what happens. Coinbase then says, oh, well, I sell some Ethereum. The Ethereum I'm selling is this Ethereum that was transferred in. The rules say you have to sell the stuff that you don't know the cost basis first. All right. So they're going to report that as a short term gain, when in reality, it's a long term gain. So you have to report it as a long term gain, which is better for you. Whereas Coinbase is going to report it as a short term gain. So then when you try to map your short term gains, long term gains between the 1099 DAs and what you got from Coinbase, it's not going to match. And the problem is the 1099 DA. So you're responsible for reporting all your capital gains. The 1099 DAs are just a snapshot. It has certain facts and certain speculation in the way the 1099 DA is created. As confusing as the 1099 DA is to the taxpayer, it creates a whole different set of confusion and problems for the revenue agent, the auditor, to try to figure out how that applies to your tax return and trying to determine whether it was accurate or not. The problem that IRS has with the 1099 DA is they're just going to be as confused as you are. While some people at the crypto office thought this was a great idea, when it comes down to the auditors, they won't be able to make heads or tails of it as well. So it's just going to confuse them. And if the auditors are confused, then you're going to have erroneous audit results, or you can have auditors just simply saying, I'm not bothering, moving on. They have not made this any simpler. They got data without clarity.